All right, so there was a huge press conference yesterday, ostensibly to announce progress on that bipartisan infrastructure deal, but obviously it was more of a campaign for the Biden agenda. Now, without a doubt, President Biden really came out the public relations winner. I mean, he talked about bipartisan cooperation, his approval for this infrastructure deal, but the problem, folks, some serious strings are attached. That's right. Slow your roll, because the president is backing what he's calling a dual-track approach and made it pretty clear that a massive reconciliation package had to go along. We're talking about perhaps $3 trillion or more. And here's the thing. They both have to cross the finish line at the same exact time. One moving like a locomotive. Everyone's down for it. The other one going to need a whole lot more muscle to get through. Joining me now to discuss, chief economist at America's at Natixis is Joseph Lavorgna. Joseph, thanks for joining us. Here's the thing that President Biden, he's now going to say, listen, I put through this bipartisan compromise. He had the photo op with a whole lot of high-ranking Republicans, but now he's holding the deal hostage. And it's ironic because I think it's the Democrats who have to pay the ransom to ram that gargantuan budget through. Your thoughts on all of this?
The infrastructure, Charles, as you said at the outset, is definitely bipartisan. People want roads and bridges and rail lines to work. Those are the things that we've wanted for a while. Infrastructure is certainly dilapidated. And so far on the bipartisan deal, the incremental spending is only, I say only, about $600 billion more than what's already been appropriated. So in terms of size, it's not massive. But however, as you say, the Democrats want to go with a reconciliation bill, which arguably is going to entail significantly higher taxes. It seems like from what Mitch McConnell has been suggesting and what we've been hearing is the Republicans don't want to go with any new tax increases. So the ability to shepherd through an infrastructure bill while at the same time doing reconciliation, those probabilities are still quite low based on what we know that now you can only use one reconciliation bill this year. So I'm not that optimistic we're going to get a very large bill, which actually would be cheered by markets because there'd be less chance, Charles, that this inflation we've gotten, which I believe is transitory, would then become permanent if we have trillions and trillions of more government spending.
But, Joe, I mean, if they're going to do it reconciliation and it's got to be all Democrats involved, that means you start with Bernie Sanders and that $6 trillion budget proposal, and maybe you start to chip away at it, but you keep a big chunk of that. That's how you get the progressives on board. You do something with Manchin. I'm thinking Senator Sinema is the wild card here. But if they were all to get on board, wouldn't it be at least $3 trillion?
Maybe, but I'm not sure, Charles, they're all going to get on board because you have a lot of House. Don't forget, on the House, where the Democrats can't lose more than 4 seats, you have a lot of Congress people in blue states that want to bring back the SALT. That runs against progressives. My old state, Connecticut, Richard Blumenthal, really panned the infrastructure deal as it appears right now. And so I'm not sure, Charles, that the Democrats are as much in line as what you might suggest. It's going to be a real battle. And not only that, we also have to pass a debt ceiling increase by the end of this month, if I recall. And we also have to pass that budget to fund the government in the new fiscal year beginning October 1. And Congress is going to go on break for the whole month of August. So there's a lot to be done and not a lot of time. We really have to thread the needle on this. So, I mean, I want infrastructure. Infrastructure is important, but it has to be done right. It has to be done in a way, Charles, that is not going to cripple the economy with significant tax increases.
Before I let you go, I heard you say you think right now, as it stands, this inflation scare transitory. Certainly, we saw the core PCE number come in a little bit less than Wall Street wanted, down month over month. And there's some other signs, even, that maybe it's slowing down. Other than a big spending package, is there anything else that concerns you that could make it longer term? Could it be wages? Could it be something else that makes this non-transitory?
I would say the productivity story is alive and well. The economy is resilient. We're going to have a 17% budget deficit this year to GDP. We're going to have a current account deficit at about 5%. So that's 22% twin deficits to GDP. If we have significant government spending where you keep those deficits in double digits, that's where you'll get the transitory inflation becoming permanent because the Fed will be monetizing it. And there'll just be too much money chasing too few goods and services. At the same time, the government is crowding out private sector borrowing.
Yeah, that's we learned that in Economics 101. Although you got to teach it over and over and over again, right? Hey, that's Joe, thank you so much, my friend.
Thank you, Charles. Great seeing you.
I'm going to bring in the Lutho Groups. You too. Jim Paulson, along with Laffer Tengler Investments, Nancy Tengler. Jim, now this week you wrote about a possible shift in the bond market, about this sort of sentiment shift. What's the message now? What's the new message on inflation?
Well, I just was struck, Charles, between how different sentiment is today versus how it was at the end of the first quarter. You know, yields were surging in March up to 1.75% of the 10-year, and break-even rates were surging, commodity prices were surging. Everyone knew we were going to get bad inflation reports, and there was just a sense the Fed was behind the curve, and this whole transitory thing, no one was paying attention to runaway inflation, and yields would soon go above 2. Today, it feels the opposite to me. Yields came down to about 150, actually into the 140s, you know, during the Fed announcement, and more and more people seem to be feeling like it is going to be transitory inflation. The Fed may well be right. Lower for longer and yields might be the case. Break-even rates have rolled over. Commodity prices have rolled over. And I think that the idea in March was if rates are just going to keep going right through 2%, then you ought to dump your tech stocks and dump your growth stocks and buy value and cyclicals. And what happened was growth outperformed, value underperformed. Today, it's almost the opposite. Now they're saying maybe growth's going to have a renaissance. We ought to dump your value stocks and your cyclicals. I kind of think, again, this might mark more about a bottom in yields than it is about a change towards growth stocks.
You know, Nancy, we certainly see the effects of the winding down of this government pandemic cash with the numbers this morning. March annualized income, if you remember, over 24 trillion, 24.2 trillion, savings at 6.1 trillion. I mean, that was from March, right? You come to May last month, those numbers are 20 trillion and 2.2 trillion. So where would the cash come from? I mean, those folks who are saying that inflation is still a serious problem, where would the cash come from that would sort of spike, the part of that equation, too much money chasing too few goods?
Well, we always have to worry about Washington, D.C., Charles, right? But I do think some of it, I'm still in the transitory camp as well with Jim, but I do think that some of this will come from people finally going back to work. I mean, disposable income is what drives consumption, and we do expect to see people returning to work pretty quickly now as many of the states are running off the $300 a week federal supplement to unemployment. But one of the things that caught my attention this week was Disney, who employed 32,000 individuals prior to COVID and are now reopening at full capacity with 15,000 and intentions of only hiring a few hundred more. That is productivity in real time. They've done it with automating a lot of the experience for the guests. And I think that's going to be a structural change in employment that the market's going to have to digest in the coming months as individuals are getting off the couch and getting back to work.
I would think for the stock market, though, I mean, they love the productivity miracle. Also, Greenspan loved the productivity miracle. It means fatter margins, doesn't it?
It does indeed. And I mean, that's what we're hanging our hat on as well. We think, wage inflation is the inflation we're worried about, but we think productivity will continue. And that's influenced a number of our holdings as we try to buy the pipes and infrastructure of productivity improvement.
What about this, Jim, this new plot twist on infrastructure? Hey, it's done. It's bipartisan, except for one thing, one little caveat. We got to ram through another $3 trillion on this side as well. I mean, is it going to go through? What do you see if it does go through for the markets?
Last night when they announced,
I'll defer to Jim. Sorry.
Well, I'm sorry, Nancy. I said last night when they announced this, Charles, I thought, wow, this is great. This is a great infrastructure bill. It's reasonably sized, and it gets it finally, after a long time, rebuilding things we need to rebuild in this country to help the private sector productivity go up. But when President Biden tied it to the reconciliation bill, I think it has no chance at all of passing. I just don't. I think that's going to kill it. And so we're probably back to the drawing board on this.
Nancy, before I let you go, I always want to tap your brain for some of your stock ideas. What are you looking at right now?
So we've been adding to technology over the last 3 months, and we continue to do so around the margin. So we added Adobe recently. We added to it. We've moved Amazon into our 12 best ideas portfolio and added to that holding. We like Microsoft, Palo Alto Networks, ServiceNow, companies that are going to benefit from cloud spend, which will easily double from here over the next few years. So that's really where we're putting our emphasis. But we do still have an overweight to energy and materials, and I'm not convinced that story's over yet.